Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So if you're a football fan, you have undoubtedly experienced the frustration of the prevent defense. You know, your team has a big lead, and then they just kind of go into this shell where instead of being aggressive and blitzing and, actually trying to stop the opponent, they sit back and, just try to prevent the big play. And this is kind of conventional wisdom in football coaching, right? The thinking is that it's okay to give up yards as long as you keep the other team from scoring because they're going to run out of time since you have this nice big lead. It's a great theory, but it seems like it never works. Like, there's actually a saying, an adage in the football world: the prevent defense prevents you from winning. And yet they still do it every single time. Well, why is that? Well, it's conventional wisdom. And we see this a lot in football coaching. They kind of all do the same thing until somebody kind of gets the guts to go rogue and try something different. And then if it works, then everybody else will kind of copycat that. Well, there's an investment world equivalent to the prevent defense. It's the 60-40 portfolio. But there was recently a crack in that mainstream narrative. The conventional wisdom might be breaking down, and I think it's an extremely significant event in the investing world. So that's a tease because I'm going to get to that here in just a few minutes. But first, I really want to thank you for listening to this show. It really means a lot to me that you take a little bit of time out of your day to listen to the Midweek Memo. And I really do appreciate it. Thank you so much. I know there's a lot of stuff out there that you could listen to. Now, if you're a lover of the show, I'm sure you want other people to love it too, right? Well, you can help us do that by sharing the episodes and by writing a good review on the podcasting platform where you listen. Give us those 5-star ratings. Give us those thumbs up and take a minute and share the episodes on your social media feeds. That will help us to grow the show and I think ultimately make it better, right? The more the merrier. So again, thank you. And if you would do me that little favor, I'll give you a big thumbs up. How about that? So, I kind of buried the lead this morning when I started the show because gold has blasted through the $4,000 an ounce level. And, it was flirting with it yesterday. I'm not sure that spot gold ever quite got above 4,000. It might have, there's various ways of determining the spot gold price. So you'll get various numbers on different platforms. I never saw it on our stream go above 4,000, but that doesn't mean that it did not. But I do know that gold futures broke through $4,000 yesterday. When I say yesterday, I'm talking about Tuesday. So we did see futures above $4,000 an ounce, but I'm not going to lie, I was really surprised when I looked at the gold price a little while ago as I was doing show prep, and gold was at $4,053, up another, $50-$60 this morning. It's pretty wild because I expected gold to break $4,000 an ounce. That doesn't surprise me, but I didn't think it was going to happen until next year. The speed of this rally is pretty staggering. Now, the government shutdown, I think, is kind of driving a little bit of this. There's a lot of safe haven buying out there for that reason. But this is pretty significant. I mean, before we got to $4,000 an ounce, we'd already seen gold go up 87% since January 2024. So it's an extremely fast move up. Now, here's a confession. I'm a little afraid the bottom's going to fall out, but not because there's any fundamental reason to think so, right? It's just an emotional reaction. I'm kind of like the whip puppy, right? The sentiment around gold and silver in the mainstream has always been so negative. And, we've heard it called a a useless relic or a barbarous relic. That's the word I'm looking for. Or, it's just a useless rock. And even Warren Buffett, he once said, oh, we just dig a hole and we put it in the ground and leave it there, and it's got no use. So there's never been a lot of strong sentiment around gold, right? Gold bugs have always kind of been labeled as cranks. And I think I did tell this story on the show not too long ago about how I didn't want to be a gold bug, right? I didn't want to be that guy. But that's just kind of the world we live in. So, even over the last 18 months with gold rallying, the mainstream sentiment has been kind of ho-hum, right? In fact, it was kind of funny, sad, not funny, haha. But even as gold was flirting with a significant milestone yesterday, right? We're seeing gold futures over $4,000 for the first time. And CNBC still managed to find the downside, right? They published an article about how high gold prices are squeezing jewelry makers. And I reshared that on our X feed, and I said, leave it to CNBC to put a negative spin on record gold prices. That's just kind of the way the mainstream is. There's an old saying that bull markets tend to climb a wall of worry. Very rarely do you see a rally go straight up. In fact, this particular gold rally is even a bit of an anomaly in my view, where we've seen relatively shallow corrections along the way. There have been corrections, but we haven't seen like these big corrections that you'll sometimes get when you're in a bull market. But this wall of worry climb, it's especially true with precious metals because the mainstream just doesn't like them to begin with. So, there's still a lot of cautious talk out there. There's a lot of people that are insisting that the yellow metal is oversold. And, right now it might be. Again, I think the government shutdown has been a big factor in this latest leg up. There's that uncertainty there. Of course, it will end. And when it does, that safe haven hedge will probably unwind. So I'm not going to be surprised if there's a big correction, and you shouldn't be either. But remember, it's all about the fundamentals, right? And the fundamentals that are driving this gold rally aren't going away anytime soon. We're talking about massive government debt. We're talking about inflation. We're talking about economic stagnation. All of these things are in play and will continue to be in play, whether or not the government is shut down or not. In fact, I would argue that the real problems with the government shutdown come after the government reopens, right? Because there's going to be more spending. There's going to be more borrowing. There's going to be more inflation. That's when you need your gold hedge. It really doesn't matter that the government is shut down right now, right? But while gold might be oversold right now from a technical standpoint, it's definitely not overowned. In fact, it's underowned. According to a World Gold Council survey, only about 38% of investors hold gold. Now, this was several months ago, so that might be up a little bit at this point. I think a lot of people are starting to pay attention to gold. But by and large, especially here in the United States, people just don't hold gold. And, that in a way, it seems kind of shocking if you step back and look at it, given the fact that gold has been one of the best performing assets out there. It was one of the best last year, and it's been one of the best historically. Did you know that the Dow Jones is actually down since 1929 if you price it in gold? It's a true story. I actually talked about this in the show last week, but it's worth repeating. At its peak in 1929, before the big stock market crash, before Black Monday, the Dow was 381.17 was the Dow. And the price of gold at that point was $20 an ounce. So if you price the Dow in gold, it was worth about 19 ounces of gold. Today, the Dow is just over 46,300. It might be higher than that. Now, I actually ran these numbers for an article a week or so ago, but close to that, over 46,000. And at the time that I ran these numbers, gold was at $3,800 an ounce. Of course, we're at $4,000 an ounce, which shows you how fast we're going up, right? These numbers are that stale just after a couple of weeks. But anyway, that means that priced in gold, the Dow is just over 12 ounces. So it's gone down from 19 ounces to 12 ounces. That represents a 37% decline decline in the Dow in gold terms over the last 96 years. So that goes to show that this monetary inflation is not only driving consumer prices up, it's also driving asset prices up, and it's giving you this false sense of wealth, when in reality, the value of those dollars is going down, 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 right? So still, only 38% of U.S. investors have any gold at all. And, if you don't have any, you probably should. I interviewed Brian London yesterday. He is the publisher and editor of the Gold Newsletter. He also is the man behind the New Orleans Investment Conference, a really good analyst in the precious metal space. And I asked him if it was too late to get in on this gold rally. And he said, well, if you're trying to do it for investment purposes and you're trying to make this big gain, yeah, maybe it is. But if you are trying to shield your wealth, you're trying to save your wealth from this relentless dollar depreciation, well, it's not too late. It's never too late, right? You just don't want to save dollars because they're not going to be worth as much in 5 years as they are today. And yet, as we see with gold, it is not only holding its value, but it's going up in value, at least priced in dollar terms. And, you might be thinking, well, Mike, gold is $4,000 an ounce now, and even silver's getting expensive. Silver was knocking on the door of its record level of $50 an ounce this morning. We're less than $1 away. So, it's hard. I don't have the money to buy an ounce of gold or even silver. Well, we have a way here at Money Metals that you can start putting your money into precious metals, preserving your wealth, saving in real money through our installment program. So with as little as $100 a month, you can begin building a gold portfolio or a silver portfolio. I'll put links in the show notes page with more information about that program. But it's definitely something to look into because it's not too late. You always have time to shield your wealth, right? If you don't have insurance on your house today, you can go get insurance tomorrow. As long as your house didn't burn down, right? You want to have the insurance before the meltdown. So it's not too late right now. So look into that program if you're looking for a way to build a precious metals portfolio, but you just don't have a big block of money to put into it right now. You can build it over time. So anyway, it's not really surprising that gold isn't generally part of the typical American investment portfolio when you consider that the vast majority of investment advisors spurn the yellow metal. They rarely recommend it, and quite frankly, they often steer people away from it. You hear people like Dave Ramsey, very anti-gold. Now, if you ask me, somebody who has a fiduciary responsibility to you, to give you the best advice, they're practicing, or not practicing, they're engaged in fiduciary malpractice when they steer you away from gold, given the performance of gold. But here's the reality, and this is what I kind of think is the bottom line. Brokers don't make a lot of money selling gold. They make money selling stocks and bonds. So, not shocking that gold and silver don't get a lot of love from these folks. They have a vested interest in you doing something else. So they're looking after themselves, not you, which again is a broach of their fiduciary responsibility. But as I alluded to at the beginning of the show, this conventional investment wisdom might be starting to shift. It would be kind of like the NFL finally saying, you know what, the prevent defense is dumb. We're not doing that anymore. Morgan Stanley Chief Investment Officer Michael Wilson recently came out with an investment strategy that includes a 20% allocation to gold. Now, again, historically, the conventional wisdom on Wall Street was this 60-40 portfolio. So what does that mean? Well, that means that you have about 60% of your money invested in equities and stocks, and then about 40% invested in fixed income investments. And this is primarily bonds, U.S. Treasuries. The theory is that these asset classes balance each other out, right? Stocks will strengthen during a strong economy, and bonds create a hedge during economic downturns. However, the reality is bonds have lost that safe haven status in recent months. We've talked about that on the show before. Last spring, at the height of tariff uncertainty, we saw gold rally, and then bonds were selling off, which was really surprising just from, kind of the way you would expect things to work. Because normally when you have all of this geopolitical uncertainty, you would expect bonds to really strengthen. This was not business as usual during a time of stock market weakness and general market instability. CNBC actually noted this at the time. They said, quote, "Treasuries and the dollar typically benefit from flight to safety environments, a function of the U.S.'s historical financial strength." And that did happen very early in the trade war, but it quickly unraveled. Like within a week or so, bonds were selling off. It's also very unusual for gold to rally when bond yields are rising, right? We saw bonds selling off. That means interest rates on those bonds were going up, and yet gold was still rallying. And it kind of underscores the fundamental strength of the yellow metal in the current market environment. And I think it's telling us something about the fiat money system. I'm going to get to that in just a second. But, given these changing dynamics, Wilson said that investors should consider a 60-20-20 strategy, swapping half of that bond portfolio for gold to serve as a, quote, more resilient inflation hedge. He said, quote, "Gold is now the anti-fragile asset to own rather than treasuries. High-quality equities and gold are the best hedges." So there's a general pivot away from U.S. debt globally, right? For the first time since 1996, foreign central banks hold more gold than U.S. treasuries as the world continues to kind of de-dollarize. And, this makes sense given the growing worries about the U.S. government's fiscal irresponsibility. In August, the national debt pushed above $37 trillion. And I've said this over and over again, there is no sign that the borrowing and spending is going to slow down anytime soon. Earlier this year, a analyst writing for the Mises Institute called the sagging demand for U.S. treasuries, quote, "red lights blinking." He said the bond market is sending a message to the U.S. government that its spending is out of control and the reserve currency privilege it has abused for the last 80 years is running out. So a major investment firm like Morgan Stanley abandoning the venerable 60-40 portfolio really represents, I think, a seismic shift in the investing world, right? It's not clear why American investing advisors have historically spurned gold. Again, I would argue that this is fiduciary malpractice to steer clients away from the yellow metal, given the persistent inflationary environment we live in. After all, gold is an inflation hedge. I wrote an article a while back, I'll link to it in the show notes page, about the fact that in the 21st century, gold has served as a very strong inflation hedge. Some people will try to tell you, no, gold isn't really an inflation hedge. It is. Over the long term, it is. So, again, I mentioned this before, and maybe it's a conspiracy theory, but I think it's true. Investment advisors don't earn big fees when clients buy gold. And then we also suffer from, I think, institutional ignorance, right? In a world of fiat money, many advisors simply don't understand gold's centuries-long performance as money and its role as a hedge against debasement. We're ignorant of history. And we've also lived through nearly 2 decades of artificially low interest rates and monetary stimulus that have boosted stocks and real estate. We have a generation of advisors who actually think that 0% interest rates are more normal than, the 4 or 5% rate level we have now. And they view gold through this short-term price lens instead of as a monetary insurance policy. And on top of all that, I think there's also a bias against gold because the entire global financial paradigm depends on people's faith in fiat money, right? This whole system is built on quote unquote trust. Well, I don't trust these people, and you shouldn't. And if you're looking at the data, you're not gonna. So they're kind of relying on this conventional wisdom to keep you a little bit blind to what's actually going on around you. Gold undermines any faith in the fiat system because we can see gold appreciating as all of these other fiat currencies are collapsing. But we're reaching the point where even the mainstream players can't ignore reality, right? The fiat system is getting shaky. As an article published by the Charts and Parts Substack noted. Morgan Stanley just blinked. Quote, gold now has a real seat at the table. And, this could lead to a broader institutional shift in strategy, again, from charts and parts. Nobody likes to go first, not in markets, not in startups, not in fashion. I would add, not in football. But once the ice breaks, the floodgates can open. This isn't the avalanche, it's a snowflake, but snowflakes can start a slide. Morgan Stanley broke the 60-40. Capital now tilts toward gold. So it's going to be interesting to see if other mainstream advisors follow suit now that Morgan has kind of brought this up. But whether they do or not, you should consider rebalancing your portfolio to include gold if you haven't already. If you're one of the more than 60% of U.S. investors that have no gold at all, you might want to think about changing that, right? The policies and economic dynamics driving this gold rally aren't going away anytime soon. This monetary malfeasance can't be voted away. The best thing you can do is prepare and shield yourself from the inevitable consequences of all of this. And make no mistake, this is ultimately about your money, right? A big move in an asset like gold is telling you something, right? So what are gold and silver telling us right now? What have gold and silver been telling us for the last 2 years? That the fiat monetary system is shaky at its very foundation. And it's not just the dollar. A lot of people right now are pointing to the dollar index and the fact that the dollar is down nearly 10% this year, which is a huge decline in the dollar. And they're associating it with the run-up in gold. And it is true that gold is reflecting dollar depreciation, but that doesn't have anything to do with the dollar index, right? That index measures the dollar against other world currencies. So what we're seeing in the DIX is a weakening dollar compared to the euro, the yuan, the yen, Swiss francs. But all of those currencies are also weakening against gold. Gold is the only money that is actually holding its value. That's why gold is going up, not just in dollars, but in every currency. Governments all over the world are devaluing their money, while gold, real money, holds up. I read the other day that silver is already at record levels in rupee terms. So in India, we've already set a new silver record. Zero Hedge actually posted a chart showing gold and silver's gains and titled it "The Death of Fiat Money." Now, that might be overstating things, right? I'm not one to think that the entire thing is going to just collapse in one fell swoop. I'm not predicting a currency crisis tomorrow. I mean, it could. It's a possibility. It's not out of the realm of possibilities, but it looks to me more like a slow decline of fiat currencies. Death by 1 million paper cuts. But think about it. Just consider dollars. Why would anybody hold them for any length of time when you know that they're going to buy 3 or 4% less next year than they do today? And I might be being optimistic. Catalyst Fund CIO David Miller recently said nobody in their right mind would hold their reserves in dollars. And he's right. The appreciation of gold, this gold rally, is the flip side of the dollar's depreciation and the depreciation of every other fiat currency. In other words, gold is tracking inflation. I mention this a lot because it's a fact that seems to get lost in the noise, but as of the end of August, the money supply had expanded by more than $1.5 trillion since its low point in mid-2023. We are now, as far as the money supply goes, above the peak reached during the pandemic. So, they wrung a little bit of that pandemic era inflation out with higher rates and some quantitative tightening. But now we're right back to the money creation again. We are in an inflationary environment now, even though it's not really reflecting as much in the CPI, although we see it a little bit. This is inflation. Again, CPI is just measuring one symptom of this monetary expansion, the rise in consumer prices. We also see inflation in asset prices, as evidenced by the fact that the Dow has lost value when priced in gold. Miller said that this relentless monetary inflation is inevitable given the massive levels of government debt. And of course, there's no sign, again, that the federal government is going to address it. It's not going to address this spending problem anytime soon because, quite frankly, there isn't any political incentive to do so. Miller pointed this out in his article. If you owed $37 trillion, like the U.S. government does, and were running a $1.9 trillion annual deficit, spending that much more than you bring in through taxes, and also had a printing press, you'd likely use it. Politicians face major pushback for austerity or aggressive tax hikes. So the easiest path is to gradually debase the currency. It's not just the US. Governments globally have learned this. That's the world we live in. And Miller said he wouldn't be surprised if price inflation ran at 5% annually. I wouldn't be surprised if it's running at 5% now, if it was measured honestly, and it might be getting worse in the future. So again, what can you do? Because it's not something you're going to just vote away, right? Now, Miller said one way to protect against this as a consumer or investor is to denominate your assets in hard currency like gold instead of the dollar, euro, or yen. In other words, use real money. And this is exactly why so many central banks are stacking gold right now. It's the only sound money. Speaking of which, after holding reserves steady in July, central banks returned to gold buying in August, adding about 15 tons of metal to global gold reserves. And this was largely in line with net purchases that we saw between March and June. Interestingly, the rapidly rising price of gold seems to have slowed the central bank's gold accumulation. Central banks globally added 166 tons of gold to their reserves in the second quarter of this year. That was a 33% quarter-on-quarter decline and the lowest quarterly demand since Q2 2022. Now, you might hear that and go, uh-oh. But even with that, gold buying was still 41% above the quarterly average that was typical between 2010 and 21. So even though it slowed down, we're still seeing a lot of gold buying by central banks. The World Gold Council noted that while central banks tend to make reserve decisions strategically, they're not totally insensitive to prices. I mean, nobody is, right? Quote, as such, gold's rally so far this year, up 26% to new record levels, has likely contributed to the slowdown in central bank buying. But that they continue to add gold in the face of a higher price underscores their continuing favorable attitudes towards gold as a strategic asset amid such uncertainty. And by the way, it's up more than 26% now. That quote was a month or so old. So in August, Kazakhstan was the biggest buyer. Other banks that expanded their gold reserves included Turkey, the Czech Republic, China, Bulgaria, and Uzbekistan. And there were not any major sellers. So I've been saying this a lot lately when I talk to people. I've already said it on this show. I'm going to say it again. This isn't something that can be solved with politics. There is no political solution to our money problem. You're not going to vote it away. You're not going to find the guys that are going to suddenly go in and get the spending and the debt under control. You're not going to vote in the guys who are going to quit running the money printing press. That's just not a thing. All you can do is try to shield yourself from the consequences of this monetary and government malfeasance. Don't hold fiat if you don't plan to spend it soon. Save your wealth in real money, gold and silver. And you can do that by giving Money Metals a call today and getting some gold and silver. The number is 800-800-1865. You can chat with a precious metals specialist. I say it virtually every week, but these folks are fantastic. When I was in Idaho a few weeks back, I got the opportunity to meet some of these guys and gals. They're fantastic. They know what they're talking about, and they're more than happy to answer your questions to help you figure out how gold and silver can fit into your investment portfolio, how you can build that. They are knowledgeable about the products that are out there. So give them a call. Tap into that knowledge. And if you're somebody who doesn't like to talk on the phone, you can go to moneymetals.com and actually talk with the Money Metals precious metals specialist via chat. Or, if you know what you want to get, you want to buy some gold eagles or, Canadian maple leafs or whatever it is that you want, you can actually go to moneymetals.com, find those products, and buy them. We'll ship them straight to your home, or we can also store your metal for you in our state-of-the-art bullion depository. But do it today. As I was talking about earlier, it's not too late to get in on this gold rally. It's not too late to preserve your wealth. They've frittered a lot of it away, but you can preserve what you have left. So make that call today and take the steps that you need to protect yourself, because it ain't going to get any better. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about all of the things that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, you can sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform if you have not done so already. And when you do, you'll also be able to tune in to our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you so much again for listening to the show. I really do appreciate it. Give us those likes, share the episodes, and have a great rest of your week. I will be back here behind the microphone again next week.